Hi, this is David Abonic Turtle, continuing the focus on CFA with revenue recognition, and I'd like to share 3 ideas, the criteria, and then 2 special cases. So revenue or sales are the top line on the income statement, so of course that's important to us as an analyst. The key issue in revenue recognition is that the seller, in provisioning these products or services to the buyer, operates under accrual accounting, you'll recall. That means that revenue is recognized when it's earned by the seller, not necessarily when cash changes hands. So the basic idea here is the seller recognizes revenue when that revenue is earned, mostly by transferring ownership to the buyer and being confident that he or she, the seller, will get paid in the future. In many cases here, an invoice is issued and the cash is collected in a future period. So the 4 criteria here under International Accounting Standards Board, IASB, which maps pretty closely to FASB, are first, that there's a transfer of risk and reward of ownership from the seller to the buyer. Second, the seller, in transferring that ownership, does not retain effective control over the goods or services. Third, the revenue needs to be measurable. Another way of saying that the price has been determined. If there isn't a price, the revenue can't be recognized. Fourth, the seller needs to be confident that the economic benefits are probable. So in other words, seller delivers the product or services, issues an invoice to collect that cash in the future. The seller needs to be confident that they're going to collect that cash in the future. Under those 4 criteria, then the seller can recognize the revenue. So let's look at 2 of the special cases. First, long-term contracts. So here the example. A technology company sells $10 million, a $10 million contract to build a network. However, it will take 3 years to build the network. How will the technology company recognize the revenue? The preferred method under long-term contracts is percentage of completion. So here, the technology company uses the cost that they incur to build the network as the estimate in order to estimate the percentage of the project that's been completed. So let's say in year 1, the seller, the technology company, has incurred 50% of their cost, and so they're going to estimate that 50% of the project has been completed. It's a $10 million contract. They'll recognize $5 million in the first year. In year 2, another 40% of the cost has been incurred, cumulatively 90%. The technology company will recognize another $4 million, and finally the final 10% of cost in the final year of $1 million means they recognize that final $1 million of the $10 million total in the 3rd year, and so that's the recognition under the percentage of completion. Notice the actual pattern of the cash flow that they've received from the customer can be different. Finally, the example that's especially relevant in the e-commerce area and on the internet is the issue of gross reporting versus net reporting. So here the example is, let's take an internet e-commerce company. We might think of Priceline, for example, where they sell $1 million worth of tickets, but it's the airlines that provision the service to the customer. So the cost of those tickets may be $900,000 or 90%. The direct selling cost to our internet company, think again Priceline, may be only $5,000. So under gross reporting, how you might typically think of it, the revenues are $1 million, the cost of sales are $900,000 direct costs plus the direct selling cost, $905, gives us a gross margin of $95,000. However, if this is a company like Priceline, where they're not really bearing the inventory risk, it's really up to the airlines to deliver the service of transporting the airline customers to their destination. Priceline doesn't really bear the inventory risk, and so they probably should use net reporting. So here, the revenues are $100,000, the $1 million minus $900, And then Priceline's cost would be the $5,000 direct, and for a gross margin of $95,000. So you can see in either case the gross margin is the same, but there's a huge difference in the booked revenues. Mainly, is this company getting credit for the revenue? They can do that under gross reporting, really, but they really have to meet these conditions. They have to be the primary obligor under the contract, which in the case of Priceline, they really are not. They have to bear the inventory risk and the credit risk. They select the suppliers and they basically set the price. So in the case of Priceline, there may be some of that, not necessarily all of that. But in general, there's a principle. We say if the company can't generally meet these criteria, it should report the net revenue, which is going to be more conservative. And so that's just a couple of the examples under revenue recognition. This is David Harper, the Bannock Turtle. Thanks for your time.